NEOS has been building one of the most diversified monthly income ETF lineups on the market today. And today we'll be diving into 6 of some of their newest funds, which covers a wide range of different holdings. So let's not waste any time and get right to it. This video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risks, so always be sure to do your own research. The first up is MLPI, the MLP and Energy Infrastructure High Income ETF. This fund provides monthly income, and it invests in US and Canadian MLPs, or master limited partnerships, and energy infrastructure companies. These companies are like the toll booths for energy infrastructure, so we're talking pipeline operators, LNG companies, and energy logistics. So companies that are dealing with transportation, storage, processing, refining, marketing, production, and mining of minerals and other natural resources. Now let's talk about the portfolio, where MLPI currently holds 24 stocks, with top holdings in Williams Companies, Enbridge, TC Energy, Pembina Pipeline, Kinder Morgan, and more. It's similar to the ETF AMPL that this fund is based on, but it has more of a mix of the big US and Canadian midstream companies. For the cost, MLPI has an expense ratio of 0.68%, costing you $68 for every $10,000 invested. And for the dividends, it has a distribution rate of over 14.5%, which is going to be paid out monthly. Now, MLPI was created in December 2025, so it's still really new, but the distributions have been looking great so far. Over the past few months, the payouts have been pretty stable, hovering around 67 to 68 cents a share, and hopefully it can maintain this level of consistency further down the road. And for the performance, MLPI has had total returns, including dividends, of around 24.6% since it was created almost 6 months ago. And in just price appreciation alone, it's up over 15.5% in the same time period, which is pretty impressive. What really stands out for MLPI is the monthly income and exposure that it gives you to MLPs, since there aren't many products out there like it. It also allows investors to avoid the headache and complications of dealing with K-1 forms when it comes to taxes for MLPs. And I think there's some nice potential in energy infrastructure, especially when you consider the growing demand in energy and data center capacity. Also, any disruptions to the energy market, policy changes, or a downturn could have a huge impact on this fund. MLPI is an energy infrastructure ETF that has paid high and consistent income so far. And if you're an investor that's looking for this type of exposure to midstream companies without the K1 headache, then this is a fund to research further. This next one is very different, and that's xqqi, the NEOS Boosted NASDAQ 100 High Income ETF. This fund is part of a new series of boosted ETFs that NEOS recently launched that aim to provide an additional 50% of market exposure. xqqi is structured close to how QQQI is. You're still getting NASDAQ 100 exposure and is selling NASDAQ 100 index call options. The difference is where the boosted or leverage part comes to play, and that's where they add a synthetic long position using NASDAQ 100 index options. This is done by buying call options and selling put options at the same strike price and expiration to create a total exposure of up to 150% to the NASDAQ 100. So if the index moves up 1%, then this fund could move up 1 to 1.5% or so. Also, the boosted exposure uses longer dated index options rather than resetting daily. And since xqqi uses index options, it gets the tax benefits from 1256 contracts of 60% long-term and 40% short-term capital gains tax. Moving to the portfolio, xqqi has 109 holdings, with its top holdings in Nvidia, Apple, Microsoft, Amazon, Alphabet, and more. And you can also see the long call here, which is part of that synthetic position. For the sector exposure, technology is over half, then communication and consumer discretionary. And this is the same structure as a NASDAQ 100 ETF, with the heavy weight into the mega cap tech names and technology in general. As for the fees, xqqi has an expense ratio of 0.98%, costing you $98 yearly for every $10,000 invested. For the dividends, this fund is up there with the distribution yield of 20% that's going to be paid monthly. Now, the dividend history is short since it was created in February of this year, but in that time, the distributions have been pretty solid without any huge fluctuations. Keep in mind the NASDAQ can be volatile, and the leverage exposure that this ETF has will cause the income to fluctuate much more than QQQI. The track record is short with this one, but since February 2026, xqqi has had returns of just under 15%, which is really good for 4 months of performance. Now, in a volatile market that's choppy and moving sideways, this fund has the potential to outperform not only QQQI, but even the NASDAQ 100 ETF QQQ. But on the other hand, in a downturn, this ETF could see much more rapid decline because of that leverage. So it's important to understand where to draw the line when it comes to your risk tolerance. And if you understand these trade-offs and you like the potential for higher income and the returns from the NASDAQ 100, then this is an ETF to look more into. Third on the list is IAUI, the NEOS Gold High Income ETF. The goal of this fund is to generate monthly income and give you exposure to gold ETPs. And it tracks the price of gold by investing around 25% of the fund's assets into gold ETPs. And it has synthetic exposure to gold through a mix of buying call options and selling put options on gold ETPs. This fund also earns income from T-bills and bonds, which are held for collateral. IAUI's portfolio is pretty straightforward. It holds the Goldman Sachs Gold ETF XXAU. Then you have synthetic exposure to gold through those calls and puts, and whatever's left in the portfolio is going to be in treasury bills. IAUI has an expense ratio of 0.78%, costing you $78 for every 10K invested. And IAUI comes with a dividend yield of 12.4%, which is paid every single month. Sliding to the payouts over the last year, the income has been pretty stable and consistent. And the increase at the start of the year was when gold was pumping up quite a lot. Now, IAUI was created a year ago in June 2025, and since then, it's had total returns, including dividends, of just over 24.5%, which is great for its first year out. Gold exposure can be a good way to further diversify an income portfolio. And in the current market, it looks like gold is likely to hold higher levels of volatility, which means better premiums. And keep in mind, IAUI gets its returns from 3 different places, and that's option premiums, collateral income, and upside when gold is rising. The downside of this fund is if gold is in a period where it's trending down, then the fund and the income are going to be under pressure. But if you're looking for gold exposure while also generating some high monthly income, then this fund could make sense for you. Next up is xbci, the NEOS Boosted Bitcoin High Income ETF. This NEOS Boosted ETF is very similar to btci, the NEOS Bitcoin ETF, which provides monthly income and exposure to Bitcoin. xbci invests in spot Bitcoin ETPs in order to track the price of Bitcoin. It also gets synthetic exposure to Bitcoin by buying call options and selling put options at the same strike price on one or more Bitcoin futures ETFs. This is the same way that the NEOS Bitcoin ETF btci works. The difference with xbci is that they're adding to the synthetic long, which is that put-pull combo, to get the extra leverage, and then they're selling additional calls to bring in even more income. And that's because the boosted funds are aiming to add up to an additional 50% in exposure. For the portfolio, there's just a few things listed. You have the Bitcoin ETP that xbci is invested in, and that's the iShares fund IBIT. Then you have the synthetic positions with the Bitcoin ETF index options, along with the treasury bills for collateral and interest. Like the other boosted funds, xbci has an expense ratio of 0.98%, costing you $98 yearly for every 10K invested. And the income is pretty high for this one, as it has a distribution yield of 38%, thanks to the volatility and premiums from Bitcoin. Jumping to the income history, there's only been a few payments so far, but you can see the payouts can vary by quite a bit each month. Given the volatility of Bitcoin, you can expect to have higher potential income, but it's going to be less stable than the other funds. xbci has been around for nearly 4 months, but in that time, it's had total returns of around 6.6%. Nothing crazy, but it's still a really new fund, and considering that it's based on Bitcoin, there could be a lot of potential for this ETF. But the reality is, this is easily the highest risk fund that we have on this list. Bitcoin is extremely volatile, and the leverage from these boosted ETFs is going to amplify the downside and the upside of Bitcoin. So it's very important to keep this in mind and adjust your exposure based on that. With that being said, Bitcoin also has a very high growth potential, especially when you consider the expansion in institutional and public adoption, its limited supply, its potential as an inflation hedge, and the case for being a long-term store of value. And if you're an investor that wants a combo of exposure to Bitcoin with double-digit high monthly income, then xbci is a fund to dig more into. Moving on to the next, we have NIHI, the NEOS MCI EFE High Income ETF. Aside from generating monthly income, this fund gives you exposure to developed international markets beyond North America. It gives you exposure to the MSCI EFE index, and like the other funds, it uses a cover call strategy using out-of-the-money call options to generate that income. And since it uses index options, it's going to have the tax advantages of 1256 contracts, which is a nice plus. The portfolio of NIHI holds the iShares International ETF, IEFA, and this ETF holds 2,650 stocks. The names in its top holdings include ASML, HSBC, Roche, Nestle, and Shell. And the sectors that it's exposed to are financials, industrials, technology, healthcare, and more. The stocks and the top holdings are pretty well balanced, and there's a nice spread in the sectors, although financials and industrials are a bit larger. For the cost, this fund has an expense ratio of 0.68%, costing you $68 per 10K invested. And for the income, it has a distribution yield of 10% that's paid monthly. If we look at the income history, the payouts have fluctuated by a decent amount month to month, but overall, it still sits above 40 cents a share. And any pressure that builds in the international markets won't help with this either. NIHI was created in September 2025, so it's 9 months old, and in that time, it's managed 11.3% in total returns, which is pretty solid. Over the last year or so, international markets have outperformed the US markets and look to possibly continue doing so in the near future. This is a big plus for NIHI in terms of growth potential and managing to provide a double-digit yield. Also, since it's only focused on international, it's a great option to get exposure outside of the US and improve diversification. Now, something to consider with international funds is that there is risk associated with geopolitics, currency, regulations, and more that occur beyond the US. But if you're looking for a fund with international exposure along with monthly income, then NIHI is definitely one to look into. Sixth on the list is xSPYI, the NEOS Boosted S&P 500 High Income ETF. This ETF is the boosted version of SPYI, which is the NEOS S&P 500 High Income ETF. It functions the same way as xqqi, but the only difference is that it gives you exposure to the stocks in the S&P 500 and it sells call options on the S&P 500 index. And like all the other boosted funds, it adds the synthetic long position through that put-pull combo to create exposure of up to 150% to the S&P 500. xSPYI also has the tax benefits of 1256 contracts like all the other funds that use index options. xSPYI's portfolio currently has 475 holdings, and the companies in its top holdings include Nvidia, Apple, Microsoft, Amazon, and Google, as well as you can see the long call in that list as well. The sectors lean mostly in technology, financials, and communications, so it's very similar to the portfolio makeup of a standard S&P 500 fund. And the same as the other boosted funds, xSPYI has an expense ratio of 0.98%, costing you $98 for every 10K invested. As for the dividends, xSPYI has a nice distribution yield of around 16.5% that's paid out each month. Now for the income history, it's going to be short, but xSPYI so far has had pretty stable income. And out of the other boosted funds, I'd expect this one to have more stability and consistency since its levels of volatility won't be as high. For the performance, xSPYI has had total returns of around 7.4% since it was created 4 months ago in February 2026. But the same boost to the upside is the same that you can have to the downside. This fund and all boosted funds will get hit much harder in a rough market than the non-boosted NEOS fund. So don't overlook the higher risk that comes with this ETF. But xSPYI is the most broadly diversified out of the NEOS Boosted lineup. And if you want more potential for income and returns while being exposed to the S&P 500, then xSPYI is one to consider. Now let's talk about who these ETFs make sense for, since they're not all built the same. First is the non-boosted funds on the list, MLPI, aiui, and NIHI. These are some of the core NEOS funds that are built around different asset classes and equities like MLP and energy infrastructure, gold, and international markets. These work much closer to traditional ETFs since you're getting exposure to the markets or assets, but there's that extra layer of monthly income from the options. And these funds can be used to create an income portfolio that's diversified across a variety of stocks or other assets. The boosted funds, on the other hand, like xSPYI, xqqi, and xbci, should be viewed differently. Remember, these are not replacements for the core NEOS funds like SPYI, QQQI, or btci. These are all levered ETFs, so when the market goes down and the NASDAQ 100 or the S&P 500 is selling off, you could have larger losses than the core funds. And the opposite is true as well, but this is the risk that you're taking on when you step into these funds. It's truly for those investors that are okay with that additional risk for that additional exposure. I think your level of exposure to these type of funds should be a small portion of your overall income portfolio. Boosted funds should be treated as the risky satellite holdings and not the core income positions. For example, if you're already getting exposure to the S&P 500 through SPYI, then xspci could be a part of the portion of your portfolio that you're willing to take on more risk for increased exposure and potentially higher monthly income. Ultimately, it's all up to you and what your risk tolerance and goals are. And I cover a variety of other great monthly income ETFs in this video here, which is on the 9 best cover call ETFs. Or if you want to learn about some other solid NEOS ETFs, then check out this video here. As always, I appreciate you watching, and don't forget to tap that like button and subscribe for more content, and I'll be seeing you soon.